Turkish currency crisis concern that it would spread. Turkish currency weakens to record low. Turkey's currency has fallen to a record low of 6.905 per dollar after falling 28% in just 2 days. Turkey's steel and aluminum tariffs have been doubled to 50% and 20%, respectively, making the domestic economy even worse. Turkey's economy worsens while seeing the solution. Just flickering. Turkey's economy has suffered from several short-term external debt increases of $123.3 billion as of May 2018, up 4.8% from the end of 2017 and accounted for 114.9% of the international reserve. Half of the debt is in US dollars. Turkey is sensitive to the appreciation of the dollar. And the problem is that inflation is high. It stands above 10% since last year. This is partly due to the depreciation of the local currency. The Central Bank of Turkey has tried to extract the weakening of the lira. The policy rate was raised to 17.75% from 8% in the previous year, but not successful. And now it seems that Turkey will have a little solution to solve the problem better, because interest rates are at their highest levels since the 2001 crisis in capital controls. It may not be a good choice. Another way to solve the problem is to ask for help from the IMF, but most debt comes from the private sector. It may be difficult for the IMF to help. There are concerns that the impact will spread to European banks. There are concerns that the problem will spread to European banks, such as Spain's BBVA, Unicredit of Italy and BNP Paribas of France. The Financial Times reported last week that the ECB has been closely monitoring the situation over the past few months. According to the BIS, the Spanish bank is Turkey's largest foreign creditor with $82.3 billion at the end of 1Q18, with debt to French, German and Italian banks at $38.4 billion. US $17.1 billion and US $16.9 billion, respectively, in both local and foreign currencies. England and the United States amounted to $19.2 billion and $18 billion. Expect limited impact on Thai economy. However, it may affect the sentiment. Compared to Asian countries and emerging markets, Thailand is strong in foreign stability, and stronger than Turkey. Reflecting the lower foreign debt levels than Turkey, there is a current account surplus of more than 10% of GDP and a level of reserves. Exports of Thai goods to Turkey account for only 0.5% of total exports. Turkish tourists account for only 0.2% of total foreign tourists, 81,000. Spillover to Thailand should be limited. However, Thailand and other emerging markets, the negative sentiment and foreign capital outflows are likely in 2Q18 if the situation in Turkey deteriorates. We believe that capital flows from emerging markets may be seen in short term.